Hi, this is TW Hughes at my blog TW on SI blog series, where we talk about things Staten Island, the greenest, smallest borough in New York City, and real estate, of course. And today we're going to talk a little bit about 1031 exchanges. And the reason for that is last week in my last vlog we talked about the benefits that real estate investments could be to your retirement portfolio, and the reason for that, and how they do fight inflation, which is now becoming a more and more serious concern. But I wanted to delve in today to more detail about a 1031 exchange and what it is and what's involved, because it is a significant investment vehicle, if you will, or technique to defer taxes. And if you're investing in real estate, it's important to understand and use the 1031. So, where does 1031 exchange come from? Well, since 1921, actually, in the IRS code 1031, hence the number, exchange allows for an investor in this case real estate, to defer taxes on the capital gains in real estate on investment properties, not on your personal real estate, your investment properties. And it doesn't matter if it's a farm or it's a multifamily, or it's a apartment building, or it's vacant land, or it's an office building. It's within real estate. And it allows you to take a gain from an investment property that you sell and roll that gain and all that investment into a new property or properties and defer the taxes. Because normally when you sell real estate you get a long-term capital gains typically, but that's taxed, so you'd have to pay the taxes. This way, with the 1031 exchange, you're not paying the tax. Now, you're taking all that money without paying the tax and rolling it into new investment property or properties, that should be more than one, and defer those taxes. And you can defer those taxes time and time and time again. So it's not like there's a limit, I can only do this once or twice. No. You can do 1031 exchanges over and over and over again. So it's a real benefit. You can defer those taxes quite long, right? There's no limit until the estate sale is done. So that's important. There are important rules with the 1031 exchange, real important rules with the 1031 exchange. So let's just cover the 5 most important rules. The first one is it's got to be like kind. Now, in real estate, that's a very broad category. Basically, it's saying you can sell an investment real estate property, invest and roll it over into another real estate investment property. That could be from farmland to an apartment building. It could be from an apartment building to an office building. As long as it's an investment property and not your personal residence, and it's in real estate, you're covered. You're not restricted by state. Maybe I want to move out of New York State. Maybe I want to sell my rental properties in New York State and move to Florida. No problem. 1031 exchange doesn't matter whether you're doing it in New York State or Wisconsin or California for that matter. You can still do this. So that's one. So it's got to be like kind. Number 2, the cost basis that you've established on the property you sell roll over to the new property. So your cost basis rolls over, but you're still entitled to the full 27.5-year depreciation on the new property. Significant tax benefit there. Number 3 is important. When you roll over, you need to roll over everything you have invested, the debt included, and to a greater investment or bigger debt. If you take any money off the table, it is called boot, and the IRS will come looking for the taxes on the boot. So the rollover has to be everything unless you're going to take some money off the table. If you do take money off the table, called the boot, the IRS will tax you for that. Number 4, you must use a qualified intermediary. So this can't be your accountant or your real estate agent or your lawyer. It's got to be a qualified intermediary. So you have an additional legal cost involved with a 1031 exchange that you would not have if you were just buying and selling real estate. It's not significant, but it's worth noting that you do have an additional legal cost. So because the IRS doesn't want you touching any of that money. So the money from the sale of the property goes to the qualified intermediary, and the qualified intermediary handles transferring to the new sale and informing the IRS and doing all the paperwork, etc., etc. So you have that. And lastly, and probably the most important and most crucial of all the rules, is timing. You have 45 days from the point that you sell a property, you sign the sale, to the point where you identify and sign the offer to purchase on the new property. 45 days. That includes public holidays, that includes weekends. It's 45 calendar days. You have only 180 days from beginning to end on both properties. Start to finish, 180 days. You go 181, you've lost the tax benefit. These dates are not negotiable. There's no delay, there's no extension. It includes all holidays and public holidays. So it's real important you understand the time frame. So again, these 1031 exchange are not for the faint of heart. They definitely require a professional, but there are definitely some real tax benefits. And for investors in real estate, it's a significant tactical advantage and strategy to be able to use a 1031 exchange. Hope that is helpful. This is TW, TWNSI. Stay well.